Thank you for standing by, and welcome to the IGO June 2026 Quarterly Activities Report. All participants are in a listen-only mode. There'll be a presentation followed by a question and answer session. If you would like to ask a question, you'll need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Ivan Vella, Managing Director and CEO. Please go ahead.
Thanks, Darcy. Good morning, everyone, and thanks for joining us for IGO's June quarter and the wrap-up of financial year 26. I'm joined this morning by Ian Rowe, newly appointed as our interim CFO. He'll be available to cover a few remarks on our finances, but also to take some questions at the back end of our opening remarks. Ian has been with IGO for some time and knows the business very well, and over the coming months he'll join me for some of our engagements with investors and analysts so you can get to know him better and have a chance to talk through some of the questions around the business. 30 June is always a good point to reflect back on the financial year, and we finished with really strong momentum in safety and performance at Nova and a solid quarter at Greenbushes, all resulting in a strong balance sheet. We recognise there's still important challenges for us to work through at Kwinana, and obviously a continued focus on Greenbushes as we work to drive towards the full potential of that amazing asset. Obviously, the fire in the quarter at Greenbushes was another key event we had to work through. I'll cover more on that later. It's great to see that recovery is largely complete. We expect the plant to start ramping up soon. Beyond that, I want to also reflect on what we've achieved. We've really tightened up and simplified our business over the last 12 months. Key transaction we talked about post-quarter that sets up Nova for a really good finish. Key message for today is IGO is a simpler, more capable and disciplined business than it was a year ago. We've got some very key areas of strength and a small number of issues that we're still working through to position us for the future. On our results summary, there's 5 key takeaways I wanted to work through for today's results. Firstly, our safety performance has improved materially. That's supported by our visible leadership and strong discipline. Our group TRIFR reduced to 3.7, and as of today, our business is over 200 days recordable injury free. The business has gone nearly a year without a significant potential incident. That's an astonishing achievement. I'm very proud of what the team's been able to deliver. Strong focus since I started this business on safety, and I think the results today, as we close FY26, are a credit to them. It's no surprise that safety performance correlates strongly with production performance and cost performance. And if we look at Nova, it's had an outstanding finish to the financial year, ahead of our life-defined production guidance and well below cost guidance. And as we approach the end of life and end of mining, it only gets more complicated, and I think that speaks to the performance and discipline of the operations team at Nova. We're also very pleased to announce the divestment to Global Lithium at the end of the quarter, or just after the end of the quarter. Together, our operating performance in this transaction are great examples of our approach and the track record we want to continue to build on. Third, Greenbushes finished strongly with the production at the top end of our revised guidance, excellent margin thanks to stronger realised pricing and the recommencement of distributions from Winfield to TLEA. The fire at TG3 was disappointing and a real setback, particularly given the plant was wrapping up extremely well and in fact well ahead of our plans before the incident. I'll cover more on that now, Greenbushes update further in the remarks. Fourth, Kwinana production was impacted by a major planned shutdown. Lithium hydroxide production volumes reflect this. The refinery remains a challenge more broadly. Addressing the performance and finding a pathway to resolution of Kwinana is and continues to be a key priority for me in the business. Finally, the financial result underpinning all of this was very solid. Our underlying EBITDA of 180 million, taking it to 286 million for the year. Net cash increased 18% to 387 million, leaving us very well positioned for disciplined portfolio optimisation and growth. Couple more remarks on safety. I'm delighted with the improvement that we've seen over the last 2 years, and in particular in the last 12 months. As you know, this has been a strong area of focus for me. Thanks to the sustained effort and visible safety leadership, we've delivered a step change in performance, and I would say we're now in the territory in terms of broader industry performance that everyone should be expecting from us. TRIFR at 3.7, down 24% in the quarter and 63% over the year. It's particularly pleasing given the number of challenges the Nova team had to work through as they pushed towards the end of life for the mine. And it's also important to call out and credit our partners, second contract partners operating at the site, in particular Meeting, which has helped deliver this outstanding change and improvement in performance. Greenbushes and Kwinana safety performance remain key areas of focus. They are not operating at the same levels, and we continue to work with our safety partners and businesses to strengthen their safety controls, performance, and leadership routines. At Nova, as I said, we delivered an outstanding operational result, finishing ahead of our lifetime production guidance and below cost guidance. Key point is that Nova continues to deliver reliable production, disciplined cost control, strong cash generation, late into its mine life, which is a very unique performance. Something that we're very proud of, really reflects well on the team, their focus all the way to the end. Quarter-on-quarter production eased as expected following a planned April shutdown, with unit cash costs increasing 29% due to the lower production profile and shutdown-related costs. Sales revenue increased 18% on the back of higher copper sales volumes and higher byproduct pricing. EBITDA was lower quarter-on-quarter, with the result impacted by an increase in our rehabilitation provisions and retention and redundancy provisions associated with our upcoming end of mine life. Naturally, we expect a number of these adjustments to our EBITDA to unwind as we close out the transaction with Lithium, and we'll report on those in due course. The production results reflect an exceptional focus and discipline from the Nova team and our contract partners, and something that they should be very proud of what they've achieved as we move towards that final stage of mining closure. We're also very pleased to announce after the quarter that we agreed to divest Nova to Lithium Resources once our mining operations are complete. This is a very positive outcome for IGO, Lithium, the local community, traditional owners, and other stakeholders who have supported Nova over the past decade. We continue to focus on our full closure planning right up to the finalisation of that agreement with Lithium. That includes extensive stakeholder engagement covering our traditional owners, local community and government. Looking forward, we've upgraded our Nova life of mine guidance through to the expected end of production in the late December quarter. The guidance is now 19,000 to 20,000 tonnes of nickel production, cash costs of $4.25 to $5 per pound of nickel. Just to be clear, this is guidance for the life of mine across the FY26 and FY27 period. It's a simple deduction of the FY26 actuals gives you implied production of about 405,000 tonnes of nickel production in the FY27 period. The Greenbushes delivered a strong finish to FY26 with production at the top end of that revised guidance that we introduced last quarter. 80% EBITDA margins for the quarter. We saw an uptick in the mine grade last quarter as we moved back into the core of the ore body, which is positive, and as something I signposted, recoveries and mill uptime meant that some of the benefits of that were not fully reflected in the production, and we expect that to flow through and improve in this quarter and beyond. With the strategic options review continuing, Talison continues to progress those work streams that we've talked through quarter on quarter. And I think a key area that I was pleased to see good progress was in the mine, taking the design, productivity, a number of changes to continue to work towards unlocking the full potential and productivity of Greenbushes. The June quarter shows some really positive trends in mining productivity. I've been down to the site 3 times over the last quarter, and it was good to see that steady improvement. Mine production was also supported, as I said, by that move into the high-grade area, as we previously signposted. Production was increased 10% to 387,000 tonnes, with CGP3 contributing approximately 71,000 tonnes. The plant was ramping up extremely well ahead of the fire in June. Most importantly, no one was hurt in that event, and the plant is now expected to restart in the coming days. The investigation has been finalised, and the team will naturally ensure that all of the learnings are embedded in their work going forward. Spodumene sales increased 12%, reflecting delayed shipment from the prior quarter being accounted for in the June quarter, while the average realised spodumene price increased to $2,286 US per tonne. The result reinforces the quality and cash generation potential of this world-class asset, particularly through periods of stronger realised pricing. Windfield resumed distributions during this quarter with a dividend of 390 million Australian dollars declared on a 100% basis. The business also continued to build considerable cash and receivables with these very favourable prices flowing through. At the same time, Greenbushes still has meaningful improvement work ahead across safety, maintenance execution, plant performance, stability and recoveries, and the broader mine and mill discipline that we expect to deliver significant uplifts in performance. At the same time, the operational improvement, life of mine optimisation, also remains critical. While the team did obviously have some focus on recovery of CGP3, which delayed some of that activity, they continue to progress that broader life of mine optimisation activity, and we look forward to sharing more on that in due course. We continue to work closely with our partners through the joint venture TLEA and Talison to help them as they build out a more stable and consistently high-performing operation. Looking into financial year 27, Greenbushes guidance that we've set has been laid out on the slide. Spodumene production between 1,500,000 tonnes to 1,750,000 tonnes spodumene at an SC6 basis. Cash costs between 380 and 440 Australian dollars per tonne, and our development, sustaining and improvement CapEx, including deferred waste, range between 250 Australian and $3 million. Our guidance reflects that ongoing CGP3 ramp-up and improvement work still required across the operation, and as we see how CGP3 comes out of the restart, we can obviously refine our expectations. On the lithium downstream, we foreshadowed last quarter that production had been impacted by a major plant shutdown designed to improve plant performance. The lithium hydroxide production was 897 tonnes per quarter. The lower production volumes reflected in significantly higher conversion costs for the quarter, as you would have expected. Sales volumes were also lower in line with production. The average realised price has improved considerably to $19,543 US per tonne. Production costs are also elevated with the refinery offline for a good part of the quarter. EBITDA loss of $88 million on a 100% basis, including the negative inventory adjustment of about $37 million. Further shutdown is underway through July and August, which will reduce our September quarter production. FY27 guidance for Kwinana is set at lithium hydroxide production of 9,000 to 11,000 tonnes, conversion costs ranging from 16,000 to 18,000 Australian dollars per tonne, and sustaining improvement capital of $75 to $90 million. With that, I'll hand over to Ian to talk through some highlights from our financials and then pick up other key points.
Yeah, thanks, Ivan. It's good to be connecting with you all this morning, and I look forward to meeting many of you at Mark there. Look, we closed FY26 with real financial momentum. Nova finished the year strongly, and as lithium prices recovered, the earnings power agreement came through clearly. For the quarter, group sales revenue rose 18% to 141 million, driven by higher copper sales volumes and byproduct prices at Nova. Our share of net profit from TLEA increased 38% to 121 million, reflecting the stronger realised spodumene price and an 80% EBITDA margin at Greenbushes. Importantly, Windfield resumed dividend distributions during the quarter, a clear marker of the asset's cash generating strength as pricing has recovered. Group underlying EBITDA was 118 million for the quarter and 286 million dollars for the full year. That includes around 31 million of year-end adjustments at Nova, relating to both an increase in year-end rehabilitation provision and the retention and redundancy accruals tied to the end of mine life. The rehab component will transfer on completion of the Nova divestment, so it is largely a timing item. Adjusting for those, the underlying result was in line with our expectations. The one standout area that I'd really like to call out is our cash performance. Underlying free cash flow nearly doubled to 70 million during the quarter, and net cash increased to 387 million Australian dollars. For the full year, we generated 134 million dollars underlying free cash flow. This capital discipline and cash build is deliberate. On the one hand, it reinforces what a wonderful asset Nova has been, generating strong cash flow right to the end. On the other, it reflects the balance sheet flexibility that we are being intentional about as we prepare for life beyond Nova. Naturally, we'll have more to say on capital management with our full year results next month, but this discipline will hold us in good stead as we look to grow the business. With that, I'll hand back to Ivan to step through our growth priorities in more detail.
Thanks, Ian. Yeah, a couple of final remarks and then we can open up some Q&A. Our growth agenda builds on that strong base that I've talked about, a simpler, tighter business focused on copper and lithium. We are pursuing growth through three paths. Exploration, which is, I guess, a real category in IGO. Bioenergy, which I've provided a little bit more detail in our quarterly, and discipline M&A. On exploration, we've cleaned up our portfolio, reset our focus on where we're operating our tenement package, and ultimately bring a focus on high quality copper and lithium opportunities. The FY27 exploration budget is 35-40 million Australian dollars. Bioenergy is another growth pathway. This was technology, sulfate leach technology developed more than 25 years ago. Presents a very timely opportunity to address some of the structural challenges of the global copper industry. And we've recently redirected some focus on this technology. It was originally created with a focus on nickel, and it clearly works across a number of different base metals, using presenting in sulfides. And so as we work through proving that out, demonstrating understanding its economic potential, we'll be providing updates. But we believe it's an important area to focus on in looking to unlock low-grade sulfide deposits where the technology might offer a different pathway to value. Very early days, there's plenty of technical and commercial work underway, and there'll be some very clear milestones before any material capital commitment. Non-M&A remains, of course, one potential route for growth in critical minerals, aligned to our strategy, but we remain highly selective and disciplined. We'll only pursue opportunities where the strategic fit, distinctive IGO advantage, where we bring real value to the table, and as you'd expect, disciplined capital allocation. Nothing's changed in this space since I joined the business 2.5 years ago. So in summary, FY26 finished strongly and leaves IGO positioned well, stronger, simpler, and in better shape looking forward to the future. Our safety performance continues to improve through the year, and of course correlates or mirrors very well with the kind of production and operating performance that we've demonstrated at Nova. It's delivered ahead of production guidance and below cost guidance for the period where the challenge was only greater as we moved into the final stages of mining for the ore body. And we announced the divestment of Global Lithium, obviously with no care and maintenance, no overlap, no increased costs carried as we look forward. Greenbushes has delivered a stronger final quarter, supported by the CGP CGP3 ramp up, strong pricing, and 80% EBITDA margin. Plenty more to do, as we've talked about, but it's nice to see a better quarter and some real improvements starting to flow through the operations. And IGO, as Ian called out, has ended the year with net cash $387 million. So plenty of work to continue doing. We've got a very focused business, continuing to look through those few challenges that are remaining on our list, and then looking for the best pathways and opportunities for growth. With that, I'll turn it over to some Q&A.
Thank you. If you would like to ask a question via the phone, you'll need to press the star key followed by the number 1 on your telephone keypad. If you would like to cancel your request, please press star 2. Management kindly asks that you please limit your questions to 1 per person and then rejoin the queue for any follow-up questions. Your first question today comes from Hugo Nicolaci from Goldman Sachs. Please go ahead.
Morning, Ivan and Ian. Thanks for the update this morning. Look, first one from me, just on the timing of cash flows between the lithium JVs. You've noted the cash that came out of Winfield in the quarter, also highlighting that CGP3 is restarting. Your 27 capex at Greenbushes is lower, and Kwinana year-on-year, your guidance is pretty similar. Is there any reason we should be aware of that the cash sweep mechanism from TLEA up to IGO shouldn't see that cash come through ahead of August?
Hugo, yeah, look, it was great to see, obviously, with the market recovery in lithium, the cash starting to really build up rapidly in Talison or in Winfield for that to start flowing through to shareholders. And that's obviously very recent. It's nice to see some cash flowing into TLEA. We'll obviously then take some decisions at the TLEA level. The board will consider that as we start to look forward and see how the market behaves. So, yeah, there's nothing beyond that I can comment on, and there's nothing more substantial or other complications that you should consider. It's, I guess, obviously a function of that market recovery that we've all been pleased to see, and now starting to see that cash flow through.
Got it. I'll wait for August then on that timing then. And then just maybe one for Ian, just sort of picking through the Winfield cash flow a little bit more. You made a comment around the receivables build. If we look at the cash balance you've reported the last couple of quarters, it does imply that there's a significant working capital piece, or maybe it's tax in terms of that cash flow piece. You ought to just elaborate a bit more on what those moving pieces are, and if we should see that working capital headwind unwind in the coming quarters and support, prices being equal, a bigger step up in cash flow coming out of the Winfield JV?
Yeah, as Ivan said, Hugo, we can't give you too many specifics other than the working capital position is really strong. Trade receivables have gone up significantly at the Winfield level, so we do expect that cash to convert over the next quarter.
Thanks, guys. I'll pass it on.
Thank you. Your next question comes from Mitch Ryan from Jefferies. Please go ahead.
Thank you, Ivan and Ian. My question is just, how should we be thinking about the ramp-up profile of CGP from here following the fire? And maybe from a more granular perspective, what volumes are in the guidance for FY27 from CGP3?
Thanks, Mitch. We obviously will, we hope that it will ramp up very quickly to where it left off. It was performing extremely well, and there's no reason to expect it won't. Naturally, I can't sit here and make any guarantees until we see it start up, but the team has done an outstanding job on that ramp up. We were headed before the fire for an extremely good quarter. It was performing very strongly and well ahead of the plan and ramp up curves that you would expect. We indicated, to get to 100% by the end of the calendar year. So no change to that. There's nothing there that says we should be surprised, but I'm obviously, not able to comment until we actually see it start up and how it behaves. One of the things I know the team was very focused on was getting, obviously, the recovery completed as quickly as possible, not just because we want the production, but because the longer the plant stands idle, the more potential for issues to emerge. And so with 7 weeks they've obviously kept a close focus on the assets, made sure everything's healthy and ready, doing final checks at the moment. So I guess we'll get back to it and hopefully start seeing some very strong production from August onwards.
Okay. Are you able to provide any of the metrics around like what you were seeing before the fire, either volume, recoveries, throughput?
Well, I'm not going to give you specific numbers, but I can tell you, as I said, when I say we're well ahead of the ramp-up curve, and I think in the last quarter I said, we're in that final part of ramp-up, which always takes a bit longer, but basically we had seen that plant demonstrate its potential recoveries, throughput, etc., very effectively. So we're extremely pleased that we came online.
Yeah, thanks for taking my question today.
Thanks, Nancy.
Thank you. Your next question comes from Austin Young from Macquarie. Please go ahead.
Morning, Ivan and the team. Just a question on the production profile for financial year 27. Should we anticipate lower volume in the next quarter, given that you're going to restart CGP3? And also, how you're progressing with the high-grade mining area? Any color would be very helpful. Just, the reason why I'm asking is just because I think the market is going to be fairly tight in August and September. So can you see if the operation has any plan to take advantage of rebounding in lithium prices? Thank you.
Thanks, Austin. Thanks for the market forecast, Steve. It's great to hear. Certainly, we look forward to that. The start with the mine, as I said, I've been down there 3 times in the quarter. I'm getting down there quite frequently, and I'm really pleased with the progress there. They are back into the high-grade core of the mine. They are being disciplined in how they provide feed to the ROM pads and the blending. We're seeing that obviously flow through and improve the performance in the plants. There's still work going on with recoveries. I'm sure there'll be a question coming, I guess, without getting into too many specifics. It was great to see post-quarter I was down there, some real improvement in CGP1 where they've had some challenges that they got on top of, and we're back on foot on recoveries. But getting back to your point on the high-grade core, look, they're there now. They've pushed back complete, and they're in a good place looking forward. In terms of production performance, I mean, the team, they'll produce everything they can and continue to drive that asset to its full potential. Our guidance indicates, based on the plans that we have from Talison, what we expect to be an appropriate range. And as we see more from that improvement program, we can obviously then tighten or revise that as needed. But at this point, that's, I guess, what we think makes sense for FY27.
Thank you. I'll pass it on.
Thank you. Your next question comes from Daniel Morgan from Barrenjoey. Please go ahead.
Hi, Ivan. Just looking to expand on the shuts and rectifications that I guess the team is planning at Greenbushes. The other concentrators non-CGP3. Just what is the timing and what would success look like from those? Thank you.
Yeah, can you just clarify? Are you talking about just improvements in general, or when you say shutdowns? I mean, they're on a normal shutdown cycle. There's nothing new or special coming up in the plan beyond the normal cycle. I think maybe just you can clarify your question.
Yeah, sorry. I think in the release you were referring to taking a lot of the learnings from CGP3 and then applying them to the other concentrators. I mean, obviously CGP3 has ramped up well.
Yeah, sorry, Dan, that makes sense. Yeah, look, I was really referring to the cause of fire. As that investigation's completed, there will be a suite of learnings, and they're hard ones. It's really difficult to see that kind of impact on our asset. But ultimately, there'll be a set of learnings that we want to make sure are rolled right back through the entire site. Obviously, in particular, the other plants.
And just on the dividend decision made at the Winfield level, can you provide any insight into what was factoring into the magnitude of that dividend and what the right, should we take this as a proportion of free cash flow as sort of a go forward rate from Winfield, or is there what other considerations were made in the Winfield dividend decision? Thank you.
Okay. There's a very structured capital framework that we apply at Winfield. The board receives a recommendation from Talison based on their debt. I won't go through the list. You guys know the kind of pieces we take into account, and that recommendation was accepted by the board. We'll obviously continue to see those quarter on quarter. With the kind of price environment, we expect to see very strong cash generation and flow from the asset. So that, was basically the first big check that Winfield's cut for a while. It was great to see that. As in signposts that we've seen, obviously, significant build in receivables, working capital position, which is no surprise, just as the price rolls through. And of course, that is to a point where that tends to just turn into cash and starts to flow quarter on quarter. And I'm preempting the other question you might be contemplating, which someone else is, and that's around the debt at Winfield. And that's something that the board will always consider and look at to optimise. At this point, we feel pretty comfortable with the level, but that's something we'll consider as things progress and we see how the market evolves.
Okay, thank you, Ivan, for your perspectives.
Thanks, Ben.
Thank you. Once again, if you would like to ask a question, please press star one on your telephone and wait for your name to be announced. Your next question comes from Ben Lyons from Jarden Securities Limited. Please go ahead.
Thank you. G'day, Ivan. Just like to press a little bit further on Hugo's initial question, please, and just noting that about $200 million is going to drop in the TLEA tin this time around. I'm just really interested in what the IGO position is as you head into that TLEA board meeting. You've essentially flagged flat CapEx guidance at Kwinana, and so clearly we're not facing into a massive capital-intensive rebuild of the refinery. And those operating guidance metrics that you've provided also imply reduced cash burn at Kwinana as well. So I would have thought there's a very high probability that TLEA distributes to the IGO bank account this time around. Just interested in your perspectives as you get into that meeting. Thank you.
Yeah, thanks, Ben. They're all valid observations as you look through the accounts and the performance. And then, we'll take that through some close consideration with the board. I can't, at this point, signpost our dividend position from TLEA. Got to step through and consider. And that the one piece that you probably didn't mention, which we've always got to contemplate, is what the forward market looks like as well, and our confidence in that. There's a lot of volatility in lithium. We've seen probably even more so in the equities than the actual underlying market, but plenty to take into account, and that at that next board meeting, no doubt that'll be a topic of discussion.
Well, thank you. And maybe just looking back to the Talison level, still waiting for an unwind of the concentrate inventories from Greenbushes and sort of keep pushing it out quarter on quarter. This question gets asked every quarter, I guess, but should we just explain, is there any reason why there's a surplus of concentrate being held at site or at the port? Is there ongoing port congestion, or should we just eventually expect those concentrate inventories to unwind? Thanks, mate.
Yeah, it's more just the flow of production, Ben, for the port does present challenges for the team time to time. It is congested. There are challenges there, and they continue to work to optimise that. And as we ramp up production further, not just CGV3, the other productivity initiatives, that's only going to get harder. So there is a stream of work focused on that as part of the broader SOR. There's no intention to hold inventory, of course. Every time we can get out on a ship, we seek to. And given the overall FY26 performance was below the production plan and the guidance, you can imagine our customers, TLC and Albemarle, are feeling that. So they're calling for that production. There's no sort of holdback. It's a question of just getting the logistics to work and get as much out as possible.
Okay. That's very clear. Thanks very much for taking my questions. Thanks, Simon.
Thanks, Ben.
Thank you. Your next question comes from Levi Spry from UBS. Please go ahead.
G'day, Owen. Just wondering about some of the longer-term plans as Greenbushes, including, are you still sort of planning on releasing the optimised long plan in September?
You just broke up a little bit there, Levi, talking about sort of the life of mine optimization SOR work.
Yeah, just wondering if you're still planning on releasing some of the longer term metrics and some of the optimised life plan as per earlier guided to in September.
Yeah, look, we continue to be eager to do that. I want to be in a position, and I think ideally have Rob, obviously as the CEO of Talison, standing up and sharing more about the business. I think that's something that's going to be welcomed and valued by our investors and analysts. The work's continuing. As I said, they did make very good progress on the mine in the quarter. Some of the other work did slow a bit due to the fire and other issues they're working through. But look, as soon as we've got something finalised through the board in a position, packing stuff, we'll be looking to find a way to get that out to the market. I know how valuable that will be, so you can get a longer term view of what's coming in the asset. So yeah, no, I guess to be really clear, there's no pullback, shying away. That's a critical stream of work. It's got significant resource and focus on it. And I think, very important for us to finalise and get out to you so that you can build out a fuller view of the potential of Greenbushes.
Thanks, Owen.
Thank you. Your next question is a follow-up from Hugo Nicolaci from Goldman Sachs. Please go ahead.
Thanks, guys, for taking the follow-up. Just firstly, Greenbushes CapEx into FY27, obviously there's a step down. I appreciate things like water and tailings are going to be lumpy, but can you maybe step us through a little bit more what is in that guidance for 27, and should we expect a step up in that tailings and water work then in FY28?
Yeah, Hugo, I can't give you a detailed breakdown, but look, a lot of it is just the normal run-of-mill sustaining and improvement CapEx. Tailings continuing. I was walking out on TSF4 2 weeks ago when I was down there. That work will continue through this quarter. As an example, there's some work on some of the water tanks as well, the storage. I think one of the key things, though, that we'll profile will move period to period, but as we signposted with a significant update to the life of mine, ORE, MRE in January, February this year, the steepening of the pit wall, the reducing of strip, of course, is going to start to flow through. And if you look under the covers in the FY27 period, you see a big step down in the deferred waste. Now, ultimately, what I'm focused on is seeing that mine productivity coming. I want to see them getting the very best out of the assets, top performance, very, very strong control around drill and blast, geotech, discipline, etc. And, where that's accounted for between OPEX and CapEx, I'm probably a little less focused. What we want to see is great outputs and performance. But with that strip coming off, you can imagine that our deferred waste allocation is coming off significantly. You're starting to see that flow through. And then, if you stand back and start looking at the all-in sustaining costs of Greenbushes, it's phenomenal. It really is. And this is where the strength of this asset shines out in comparison to all of its peers in the hard rock world. There's just no one close. And I think it's only going to get better with the improvements, productivity uplift that's coming. And it continues to push Greenbushes. Yes, they've had some setbacks. Yes, as I've said, tough quarter last quarter to deliver a downgrade on guidance. This is the sort of improvement in performance. There is no back off on that. And as they deliver that, I think continues to position Greenbushes as one of the most competitive sources of lithium units in the world, regardless of the nature of production, be it brines or otherwise.
Got it. Thanks for that, Ivan. And then just maybe one on the sale of Nova, and just sort of working through that one for my benefit a little bit. Look, I appreciate obviously a lot of provisions there. I think, your December half year, you had about $120 million of provisions on the balance sheet. You've added a little bit to that today, but selling it for $7 million, so call it sort of $130 million of sort of enterprise value there. It seems like a lot of the infrastructure that, the replacement value of a number of just those components would be considerably higher than that. Appreciate, it's only worth what someone's prepared to pay for it, but it seems like, a relatively low value to realise. You just comment on maybe some of the other, liabilities there, or sort of why sell it for what I perceive to be a relatively low value versus the installed asset base?
Let me throw that one to Ian. He actually ran that transaction, which is great. Did that in his spare time, and he can talk you through the background and logic there. Hugo, it's a great question.
Yeah, thanks, Hugo. Obviously, you called out the headline consideration, which was $7 million for us. It's a share transaction, so we're selling the Nova entity, including all the representation obligations that go with that. I think we noted accordingly that the balance attributed to Nova at 30 June is roughly $70 million. For us, we obviously explored a number of opportunities, options for that asset, including moving the plant, which you wanted to, and frankly, this is the best overall value proposition for IGO by the time your customers dismantle the plant and move it elsewhere. It sort of sets in the dollars. So look, it's a great outcome for IGO, for our people, and the fact that we'll be able to complete that transaction as soon as possible after the completion of mining operations means that we can, reduce the ongoing cost base there and focus on growth.
I'd just add a couple of additional points. Part of it is also ensuring we've got a very credible counterparty to take on those obligations. And that's something we looked at carefully. And I think Global Lithium will get full value from the assets. To your point, they're only 10 years old. They're fantastic assets, and I'm sure all that will serve them very well. But that closure liability and requirement, that future work, we want to ensure that that's dealt with professionally. We did a lot of work on the closure planning, and so that's an important part of the decision. I think the other factor to take into account, Hugo, is the location of Nova. It is very remote from a lot of other mines in WA and resources, which makes it more challenging. If you had transplanted that into the middle of the Goldfields or in the Pilbara, then sure, it could be a very different story. But given where it was, I think this is an outstanding outcome for IGO. We've avoided any termination, any holding costs, literally wrap up production, take the concentrate, and then finalise the transaction within days. So it's about as optimised as I think we could ever expect. I was really pleased what Ian and team in the street there. Something to be very proud of.
Yep, got it. That's clear. Obviously, the remoteness making a big impact there. And then just lastly, if I can, just give a sense of the timeline where we should maybe start to see some of the drilling and exploration pieces come through at Cosmos and some of these other assets over the rest of FY27?
Sure, yeah, great question. There's drilling happening right now at Cosmos, which is good. So they've been in there for a couple of weeks. Assays are due in soon, which will be interesting. There's some drilling up in the Kimberleys, which will start with finalising heritage clearances. And there's a number of projects internationally that we're working through, and I'd expect those to all start to see exploration spend in the ground through FY27. As I said, predominant focus on copper for that work, and quite a big shift in approach for exploration. We have a deep capability in our organisation. Absolutely outstanding technical capability, but we have really reset the whole strategy and approach, and we are pursuing areas where there is basically no mineralisation or very, very high prospectivity. As I said, strong focus on copper And, of course, some jurisdictions where we expect that we can turn that into online. This isn't about just trying to find a resource and then, figure it out later. So we're thinking through these projects from start to finish before we start committing any capital towards them. And as we get further into that program, I'll definitely report more and maybe get John Gilroy out of exploration to come in and provide a deeper dive on it. It'd be nice to not just talk about Kwinana. And as much as I love Greenbushes, I want to see improvement, but it'd be good to pick up another key thread as part of our business and our growth agenda.
Got it. So just at a high level then, should we expect exploration to step up in FY27 versus the, I think, 33 million spent in 26?
No, look, our guidance remains 35 to 40. We think that's an appropriate amount of allocation from our balance sheet. Actually, we will continue to try and turn Tenement over and draw value from it. So in other words, we're not saying that we always should draw that much off the balance sheet, but that's the envelope that we've allocated. We think that's appropriate for our business, for the targets, the direction we're taking. Naturally, if we do hit significant mineralisation, then we might take the decision to allocate more, and that's something we go through with the board carefully. But at this point, just roll forward that 35 to 40. I think that's the right envelope.
Cool. Thanks, guys. Appreciate the follow-ups.
Thanks, Hugo.
Thank you. Your next question comes from Andrew Harrington from Petra Capital. Please go ahead.
Thank you. Morning, gents. So my questions were all around the exploration work and the spend, so you've answered most of those. Perhaps you can add more color into the projects and locations that you're going to be focusing other than Cosmos?
Yeah, I'd love to. I won't yet because we're not quite there to announce all of those things. They are exciting, and if you start to think about major copper belts, where we could expect to be targeting considerable copper mineralisation, it's most likely not Australia, and that's the hard news. I guess there isn't a lot of ground in this country. Where there is good, it's generally held very tightly by other players. I'm not trying to avoid the question. I just can't be too specific yet. There's one area that we're focusing on in Australia that we think offers some opportunity, and the rest is international. The one that we have announced so far is, of course, Copper Wolf in Arizona, and we expect drilling to start later this year on that. We have a number of very interesting targets there that the team has worked through. We completed the transaction recently to take 100% of that tenement package, and I really look forward to seeing the results there.
And will anything be spent on lithium exploration?
Yeah, possibly. I mean, we've continued to work through some clearances and some targets in the Cosmos tenement package and also Forrestania. There are clear indications of pegmatites in this area, and you see with Cosmos, you've got Kathleen Valley, which is an amazing ore body just to the north of it. But we're just stepping through the process to get clearances and then prioritise our drilling accordingly as we go.
Okay.
There's also some tenements in the Northern Territory which have also had some focus, and the team's continuing to work through their data and look to see if there's any further targets they want to put drilling into through FY27. So, look, lithium's far from off the agenda. It's just continue to be very surgical where we place the money in exploration.
Cheers. Thank you.
Thank you. Your next question is a follow-up from Austin Young from Macquarie. Please go ahead.
Thank you, Ivan. Just a quick one on the downstream. So in the last 12 months, we can all see the value is accruing at the upstream. Keen to understand, given you have additional work planned for Kwinana, have there been any progress on, how to approach this project, given your discussion and meeting with your JV partners? Thank you.
Yeah, you're a little bit quiet there, Austin. I think talking to projects focused for Kwinana, the shutdown that we saw in the June quarter, and then we're continuing now, was focused on 3 areas: normal shutdown maintenance, routine maintenance. Secondly, improvements to lift the nameplate or lift the performance or approach the nameplate in the asset. And the third, which we mentioned in the quarterly, was the gas treatment facility, which is an important requirement to make sure that we meet all of the environmental conditions and the operations of the future. So that work will obviously close out with its current shutdown, and then we'll see how the asset's performing. The team at TLEA at Kwinana are naturally dedicated very heavily to deliver the best production performance that they can, and are doing a great job stepping through those projects. Ultimately, that unfortunately does change the challenged economics for lithium refining in Australia, and that's not just a function of Kwinana, something that we all have to recognise. It's obviously been compounded recently with the increase in sulfuric prices, other input costs, but ultimately that's a broader piece of work for us to talk through.
Yes, just on that point, I was trying to understand any progress in terms of how you approach this project at the joint venture level has happened. Would you share it or any opportunity to hand it over? Have any of those been explored? Thanks.
Austin, we continue to work through those questions and concerns with TLC, and nothing's changed from an IGO point of view. Our position remains consistent. We're just working through that respectfully with TLC to see what pathway can be achieved, and we'll update you further once that work's completed.
Thank you. I'll pass it on.
Thanks, Austin.
Thank you. Your next question comes from Lyndon Fagan from JP Morgan. Please go ahead.
Good morning, Ivan. First question I had was just on Greenbushes grades. Why weren't they up more in the quarter? I thought we were expected to get a bit more of a recovery. And then the second one I had was just in terms of the tailings retreatment plant, in which year does it actually run out of tailings to treat and need to, I guess, have an investment to take ore?
Okay, thanks, Lyndon. On grades, first of all, we're back into that high grade 4, and what we're seeing is, I think, disciplined mining, disciplined management of the ROM feed for each of the plants. And so we're now targeting the right grade for the right plant. You see a higher grade into TGP1, that's how it's designed, and still by industry standards, a very high grade into 2 and 3, but quite a step down. And what we want to do is manage that feed and control that in a very disciplined manner. As you know, the reserve grade for the life of mine is something we need to be conscious of. If we were to just continue to mine above that consistently, you can imagine that you create a shortfall later. By starting to get this discipline and control into the mining sequence and the way that we create those ROM feed stockpiles allows us to balance and smooth out that performance through the operation. And we're not looking to just throw the best high grade material at these plants just to try and hit a quarterly number, for example. So ultimately, I'm really pleased. We're back in that high grade. We're managing it in a disciplined manner, and you should continue to see that run through the production results looking forward. On tailings treatment facility, you probably can imagine that the grade has dropped off through FY25 into FY26. Was really significant in the early days, I think above 1.4% lithium, and it's down lower than that now. The team is still producing well from that asset, and they're continuing to study and assess the potential resource and how far we can extend that with the old tailings facilities at Greenbushes. At this stage, I think that will take us well into 28. But until that work's finished, I can't give you a definitive answer. And in parallel, the study work is then continuing to say what kind of crushing grinding capacity would you put in front of that facility to continue to leverage the flotation circuits and the production volume capacity that's there. Again, once that work's further progress, they can give you an update. But I think the takeaway is we're not expecting any dial back of those funds. I mean, it's a great facility, maybe not as substantial as Chem 1, 2 and 3, but still offers considerable valuable production capacity at the site, and that will take us well through the back end of this decade.
Thanks. And just a quick follow-up, if I may, on the CapEx. So it seems like FY 27 at Greenbushes is more or less just a stay in business type number. Do we read into that there's a lack of desire from all of the partners at this stage to spend on growth? I mean, I realise you haven't come out yet with the life of mine optimisation study, but I mean, there doesn't appear to be anything in there for early works or I mean, is that the right interpretation?
It's a great question, and you commented on that SOR, or that life of mine optimisation. That is a place where we stand back and look at the big picture and say what's the right sweet spot for production volumes and therefore the capital allocation across the site. There's no question that more tons equals more money. I mean, we know that volume equals value in one sense. But, doing this in a really thoughtful, planned and disciplined manner with a long-term plan, I think is what we should expect from Greenbushes, from the owners of that asset. And I'm really pleased that the board's obviously working through that with that mindset. Clearly there is potential for more production growth. We've all talked about Hem grade before, and it sits out there. That asset, the broader mine, has got enormous potential, but I think showing that we've got existing assets running extremely well, meaningful potential, running above nameplate, really delivering on costs and structured and disciplined maintenance, very high recoveries, all of these foundations, I think, then earn the right to grow, rather than just saying, well, because the market needs more, it's a good plan to just throw the capital at it. And, Rob's taking, I think, a very thoughtful approach to those improvements, and then broader SOR will be in a position to say where does that next major step of growth fit.
So just to pick up on that, you reckon it hasn't earned the right to grow at this stage?
Yeah, I don't think we've reached full potential. So, obviously this financial year, or FY 26, was a tough year for Greenbushes. It's finished well the last quarter, but it's had some difficult periods, and there's still plenty of improvement going on. And I think the ability to translate that capability back into a new asset means that we're going to squeeze every last strip of return from new capital that we allocate across the business. And whether that's for a temporary plant or new assets in the mine, it doesn't really matter. I think that's good discipline in any mining operation.
Great. Thanks for all of that, Ivan.
Thanks, Ian.
Thank you. There are no further questions at this time. I'll now hand the conference back to Mr. Vella for any closing remarks.
Thank you, Darcy. Thanks for the questions. We've covered lots of ground there, and we're right on time. So just as a quick wrap-up, a very strong finish to FY 26, leaving IGO in a great position as we look forward to the next stage of this business. Transformational lithium safety performance and a strong correlation, obviously, with the operating production disciplines and performance and outcomes at Nova. The transaction with Global Lithium, I think, positions us extremely well and simplifies our portfolio further. Greenbushes, strong quarter and a good finish to the financial year, 80% EBITDA margins, and a imminent restart of CGP3 sets us up for a great start to this financial year. IGO ended the year with net cash of $387 million. Strong balance sheet, strong cash position. All in all, there's still work to do and some key issues that we're working through. I think a lot of that's been covered well on the call. Thanks for everyone's time and attention. We look forward to updating you further after our year-end results are announced in August. Bye for now.
That does conclude our conference for today. Thank you for participating. You may now disconnect.